Institutional Equities at Ambit. Nitin, good afternoon. Good to have you with us here. Thanks very much. I think the big talking point is, of course, what's happened with the IT services, and Rima has been covering that for us. And Surabhi was reminding me that you had a bit of you were constructive on IT, Nitin?
Yes.
Back in March, you still hold that view after the result season? Maybe too late to sell, but do you think it'll make money from here?
I think you're right. For the last month and a half or so, our strategy call was to go underweight on banks and perhaps increase weightages on IT. Hasn't worked out. In the last 1 month, IT sector has underperformed the bank nifty by about 5 or 6 percentage points. I think clearly that's what the past is. However, we are continuing to see that there is more risk building up on the credit in India in terms of credit growth, in terms of NIM margins, etc. So we believe that if you were to take a little longer view of 3 to 6 months, our view for the midterm for our investors, institutional investors, is from here on perhaps to not that much of risk of FY26 earnings estimates, at least for the large caps in the IT sector.
But Nitin, just elaborate on that call, because earnings estimates anyway, they're so feeble, right? We're talking 0 to best case 3-4% growth. So what is the view? Is it just going to be a play on the cash, maybe better buybacks and dividends? Or is it that you're bearish on other parts of the market? Like you mentioned, banking. So I'm sure the call is in tandem with the other tactical allocation. So just elaborate on that. And also the negative view that you have banks, that's turning out to be, absolutely spot on, at least just looking at short-term earnings. First quarter has been really disappointing. Barring HDFC and ICICI Bank, most others have disappointed, either on margins or on asset quality or both.
So, fair point. I think what we've been highlighting is that we are into the fiscal year in which the flows are reducing because of the last 12 months of Nifty performance or funds performance, because of which, and entering into a fiscal year where the earning estimates are very feeble. Again, remember, the whole Nifty is not supposed to grow earnings more than about, let's say today, 8 or 9%, which is not any different from about 1 quarter back, 9 or 10%. So in a market environment where flows are perhaps reducing, number two, where the earning estimates are very, very frail or feeble or low numbers, where do you actually go and park your money? We've seen such cycles in India in the last 15, 17 years twice play out for about 2.5, 3 years, where market has increased in concentration, and which profits start becoming concentrated. And hence the three sectors which have performed in each of those two cycles in the past, when we've had that in 2010 to 13, or let's say between 17 to 20, what we've seen is IT, FMCG, and pharma have historically, delivered or outperformed the market. That could be one of the reasons that we have in saying that where the market moves, perhaps for the next 6 months or 12 months or slightly even longer. We've already seen market move sideways for the last now 9-10 months. Where do you go and lose less money? Perhaps that was the call. FMCG, pharma, which includes healthcare also, plus now IT. So that was one of the larger thinking behind this call. In the near term, what we said was the IT sector has seen a lot of downward revisions in the last couple of weeks or 3 weeks. And with that behind us, we thought that it's right time to add IT, but clearly hasn't worked out. But we said banks would actually go through more downgrades. It could continue in June as well as in September quarter.
So Nitin, the call is in the second half of the year, things get really tough for the Indian markets. We're in for a correction.
So clearly, I don't know about the market correction. We've seen periods in the past where we have seen markets move sideways, not generating more than about 2 to 4% CAGR or -2 to -4% CAGR. Because what are we looking for? We're looking for flows to pick up in India with a considerable trend, or we're looking for earnings trajectory to actually recover. Clearly today, FY27 earnings may be looking buoyant, but FY26 earnings clearly aren't looking buoyant. And if you look at the flows also, Last one quarter may be good, or 1 month may be good for domestics. But again, FIs have turned sellers in the last 1 week or fortnight. And what we see is pretty much a very unpredictable or not a very secular trend of flows. So hence, where earnings visibility is, at best, high single digits, or perhaps, low single digits or mid single digits, and flows moderating, I don't see markets going considerably to higher levels. It could oscillate for the next 6 months to 9 months also.
Speaking of earnings, that's a big top-line miss for BEL. It's a wide miss, almost 600 crores of a miss. The profits are fine. Maybe at the top line, it could be some spillover effects, some orders moving in, maybe to the next quarter. The revenue estimate that we were working with was around 4,800 crores. The company's done, far lesser than that, though the EBITDA line and the margin line is not too bad. And that explains why the stock perhaps is holding up. In fact, they announced an order. BEL, in fact, just over the weekend announced a big order. It was a 2,000 crore rupee order. So that's what I'm saying. I'm not sure if that was expected to be accounted for in Q1 and spilled over to Q2. But anyway, that's BEL, and stock is in focus. We'll get you more on the earnings in just a bit. On earnings, Nitin, hearing you out, we started the year with everybody telling us FY25 was bad. We had 5-6% earnings growth. On that low base, 12-13% to ho jayega. But will it happen? Do you see those numbers come through for the full year?
I think I've shared this before as well, that if you look at the last 15 years in India, every time we start the year at about 18-19% earnings growth expectations, and we moderate ourselves down to 11-12%. Perhaps that's the signs of optimism every country or every market faces from the sell-side analysts. This year around, we started the year with about 10 or 11% earnings growth, and we've already come down to closer to about 8 or 9% earnings growth. Last I checked was that mid caps and small caps have done slightly better than the Nifty earnings for this year. This quarter, with about 24 odd companies announced numbers, we're only up about 5% PAT growth as compared to 7% last year and 12% the quarter before. So I think earnings growth, as I said in the beginning, we're looking for, market always looks for, I think, earnings, or looks for event, or it looks for flows. Clearly, earnings are not playing out, flows are moderating. The event which is coming up to all of us is perhaps the festive season. And we all know that the consumption trends are again volatile. So the market will start looking at the trends of consumption going into the festival season. That information will start dominating the market moves or gyrations in the near term.
Nitin, just a quick word. So the big sector calls are you're bullish on tech, pharma, consumer, and you're negative underweight on banks. What about some of the smaller, themes like platform companies, quick commerce, or real estate, defense, realty, cement? What about, just quickly take us through the overweights and underweights here?
Sure. We've spoken about this, that as the market moves sideways, or perhaps it's very difficult to find trend-like behaviors in one particular index or otherwise. It's a stock pickers market. We've maintained that for the last 6-9 months. And you can see that stocks wherein the FIs came in the last 3 months, whether it was heavyweights such as Bharti, Reliance, an ICICI Bank, or an HDFC, those stocks performed really well. Whereas, where they sold, perhaps they didn't do that much well, whether it's an SBI or Infosys. So I would not hazard a guess at a single sector, a single theme, barring those 3 sectors which you mentioned, overweight, an FMCG, or healthcare/IT, I would say in the near term. But again, in that you'll have to be selective. So let's say even in IT, why should one be actually thinking of TCS? And why not things such as relatively inexpensive, can't actually see more downgrades like TechM, Infosys, or Cognizant? Those would be the ones. So I think we'll have to see what stocks, defense, etc. We aren't finding them to be any, beyond a theme right now. Hence, we would advise staying away from thematic, but more focusing on quality of companies.
Okay, and next time we will talk about specific companies, because I think you sort of have a decent small mid-cap coverage universe as well. And on the back of earnings, I was noticing some upgrades, some earnings cuts, and so that kind of action as well. So we'll talk about that. For now, thanks very much, Nitin, for coming on as always here. Appreciate your time. BEL